All right, let's jump right in. Today, we're going to pull back the curtain on the world of investing. We're talking about the core products, the actual building blocks that power everything from your retirement savings to those big funds you hear about on the news. Let's get to it. So, you hear these words all the time, right? Stocks, bonds, derivatives. And if you ever felt like your head is spinning from all the financial jargon, you are definitely not alone. The world of investing can feel, well, intentionally complicated. But what if I told you it all boils down to just two really simple ideas? Yep, that's right. Pretty much every investment product out there is just a fancy version of one of these two things. You're either lending your money to someone or you're owning a piece of something. Simple as that. So let's start with the first one, lending. Okay, so this first big idea is all about you becoming the lender. Imagine this. You have some money and a big organization, say a government or a major corporation, needs it. You agree to give them a loan, and in return, they promise to pay you back, plus a little extra for your trouble. That, right there, is the foundation of what Wall Street calls fixed income investing. A bond, which is the most common type of this, is really just a formal official IOU. You're not buying a piece of the company or anything like that. Nope. You are simply its lender. The company is now officially in your debt, and it has a legal obligation to pay you back based on whatever terms you both agreed on. The whole process is actually pretty straightforward. First, you lend the money out by buying the bond. Easy enough. Second, you get paid for it through these regular interest payments. Fun fact, they're often called coupons. And then finally, when the bond's term is up, when it matures, you get your original investment, the principal, paid back in full. Okay, but here's where it gets really interesting. Let's say you own a bond that pays you a nice 4% interest every year. What happens if, all of a sudden, the market changes and brand new bonds are now paying 5%? Well, suddenly your little 4% bond doesn't look quite as attractive anymore, does it? And this creates what's known as the interest rate seesaw. Picture it. When new interest rates out in the market rise, that fixed lower rate on your older bond becomes less desirable. So if you wanted to sell it, you'd probably have to offer it at a discount, a lower price. And of course, the opposite is true. If market rates were to fall, your bond's higher payout becomes way more valuable, and its price actually goes up. This inverse relationship is probably the single most important rule of the bond market. Just remember that seesaw. As interest rates go up, bond prices go down. And as interest rates go down, bond prices go up. It's that simple. All right, time for our second core idea. We've talked all about lending, so now let's talk about owning. Instead of acting like the bank, you actually become a part owner. You get a direct stake in a company's future, and hopefully, its future success. And this is exactly what a stock or an equity represents. It's a share of ownership. It's your little slice of the pie. It's your claim on a company's assets, and importantly, its earnings. So if the company does well and its value grows, the value of your share, your slice of that pie, can grow right along with it. And owning that share comes with some pretty cool potential benefits. The one everyone knows is capital appreciation. That's just a fancy way of saying the value of your stock goes up over time. But you might also get dividends, which are basically your share of the company's profits. And you might even get voting rights to help steer the company's direction. But, not all ownership is created equal. There are two main flavors, common shares and preferred shares. Common shares are what most of us think of when we say stock. They give you voting rights, they have the highest potential for growth, but they also come with the most risk. Preferred shares, on the other hand, are kind of like a hybrid. They usually don't have voting rights, but they pay a fixed dividend, which sounds a lot like a bond, right? And here's the kicker. If the company gets into trouble, preferred shareholders get paid out before the common shareholders do, which makes them a safer bet. So we've got lending and we've got owning. But there is a third, more advanced category out there, derivatives. Now, these can seem super complex, but the core concept behind them is surprisingly straightforward. And don't worry, we're not about to get lost in a sea of complicated math. The real key here is just to understand the fundamental idea, which, believe it or not, is simpler than you probably think. The big secret is right there in the name. A derivative is a contract whose value is derived from something else, an underlying asset like a stock, a bond, or even a commodity like oil. So you don't actually own the thing itself, but you own a contract that's about that thing's future price. One of the main reasons people use derivatives is for something called leverage. So check out this example. You pay just $2 for a call option. That gives you the right, but not the obligation, to buy a certain stock at $20. Now, let's say the stock price shoots up to $25. You can exercise that right. You buy at 20, you immediately sell at 25, and after you subtract your $2 cost, you've made a $3 profit. A 150% return on your tiny $2 investment. That is leverage in action. But, and this is a huge but, if that stock price had stayed below $20, your option would have expired completely worthless, and you would have lost your entire $2 investment, a 100% loss. High risk, high reward.
So there we have it, our 3 building blocks: lending, owning, and these advanced tools like derivatives. So how do the pros use them? Well, they combine them to create a kind of portfolio blueprint.
Seriously, if you could peek inside any mutual fund, ETF, or pension plan, you would find these exact same fundamental pieces. They're like the financial DNA, and they're just combined in all sorts of different ways to achieve different goals.
The pros, the portfolio managers, they take these blocks, the stability of bonds, the growth potential of stocks, and the strategic power of derivatives, and they assemble them into all the different investment funds that are available to us. They're constantly trying to balance that scale between risk and potential reward.
And that leaves us with a really powerful way to think about all of this. By just understanding that almost everything is some form of lending or owning, you can cut right through the noise and the complexity. So the next time you look at any investment, just ask yourself one simple question: am I being the bank, or am I becoming an owner? Knowing the difference is truly the first step to building your own financial future.